As I look ahead to 2026, I am not expecting a dramatic reset or a sudden boom. I see a year shaped by pressure, patience, and positioning. Markets are adjusting to a world where inflation stays stubborn and interest rates stop offering easy answers. As an investor managing a portfolio with a medium-long view, 2026 is about new opportunities. I expect both US and European markets to move forward, but not evenly. Returns will come from select sectors and careful allocation, rather than broad market lifts. In the United States, interest rates are likely to remain steady. The Federal Reserve appears boxed in. Inflation is no longer surging, yet it refuses to fall back into target ranges. Wage pressure, housing shortages, and ongoing fiscal spending keep prices elevated. Cutting rates too early risks reigniting inflation. Raising rates risks breaking something more serious. The most realistic outcome is a long pause. That creates a mixed environment for equities. Growth stocks no longer benefit from falling rates, but they do gain from certainty. Large technology firms with strong balance sheets and global revenue streams continue to hold appeal. Artificial intelligence infrastructure, cloud services, and semiconductor supply chains will be on every investor's radar, including mine. The financial sector in the U.S. presents a different picture. Banks operate in a steady rate world that supports margins. However, credit risk is rising. Consumer debt levels are high. Commercial property remains fragile. I expect select large banks to perform steadily, while smaller lenders face pressure. This is a sector where balance sheet strength matters more than growth stories for portfolio managers. Housing remains one of the most important economic forces going into 2026. Mortgage rates in the U.S. and Europe are unlikely to fall meaningfully. That keeps affordability strained and limits transaction volumes. Homebuilders globally will continue to see demand in supply-constrained regions. Europe faces similar challenges, with different constraints. The European Central Bank deals with uneven growth across member states. Inflation remains above target across much of the region, driven by energy costs, labor shortages, and supply chain realignment. Rate cuts are discussed often, but delivered slowly. European equities trade at lower valuations than U.S. peers. That attracts capital, yet growth remains slower. I see opportunity in industrials, defense, and energy infrastructure. Europe continues to invest heavily in energy security and manufacturing capacity. These trends support long-term capital spending in this high-growth environment. Consumer-focused sectors in Europe face headwinds. Higher mortgage costs and food prices squeeze disposable income. This limits upside for discretionary retail and travel. Luxury brands may fare better due to global demand, but volume growth remains uncertain. I will stay selective and avoid broad exposure. One market that often gets overlooked in global discussions is Australia, which plays a role in global portfolios and offers a clear contrast. Australian interest rates are likely to rise further. The Reserve Bank of Australia has fewer tools left to manage inflation. Population growth, housing shortages, and services inflation keep pressure on prices. Uncertain mortgage rates in Australia place stress on households. This affects consumer spending and housing activity. It also supports banks through higher lending margins, though credit risk must be watched closely. For global investors, Australia becomes a yield-focused market, rather than a growth story via their dominance in mining exports. Inflation staying above target across regions shapes everything. It changes how companies invest. It changes how consumers behave. It also changes how I think about portfolio construction. Real assets, pricing power, and cash flow matter more than distant growth projections. In 2026, I am not positioning for extremes. I am positioning for resilience. That means a mix of established technology leaders, selective financials, energy exposure, and defensive assets that hold value in inflationary periods. It also means accepting that volatility is part of the environment, not a temporary disruption. The next phase belongs to investors who understand risk, respect macro forces, and stay focused on fundamentals.